Hello everyone. Welcome to my Workbook Solutions video for Managerial Accounting. This video covers Chapter 21, Budgeting. Please note that if you are watching this video at a much later date than it was posted, the chapter number may have changed as well as the page number of each example in your workbook. Overall, that shouldn't matter as the example problems we'll work through will still help explain the material. I'll also show the question in its entirety within the presentation, so you won't actually need a physical copy of the workbook, though having one will make the process much easier for you. Without further ado, let us proceed. Let's begin on page 2 by building a production budget. Miles Manufacturing has prepared the following sales budget for the first 4 months of the year. Miles estimates that it will begin the year with 3,000 units of inventory. The company wants to end each month with inventory equal to 25% of the next month's projected sales. Prepare a production budget for January through March. Our starting point for this particular budget is always sales. To calculate how many units to be manufactured, first add the desired ending inventory. The problem specifies that Miles Manufacturing desires a monthly ending inventory equal to 1/4 of the next month's sales. So January's ending inventory will be 5,500 units, 22,000 times 25%. Likewise, February's ending inventory will be 6,250 units, 25,000 units times 25%. For March, it will be 5,250 units, 21,000 units times 25%. Sales plus desired ending inventory gives us the total inventory we need, but that's not necessarily the amount of inventory we need to produce because we already have beginning inventory on hand. So we will subtract that number from the total of what we need to make. January's beginning inventory is estimated to be 3,000 units, meaning we must make 22,500 units in January. For February, January's ending inventory will be February's beginning inventory, giving us a production quota of 22,750 units. In March, the carryover ending inventory from February is 6,250 units, yielding a production quota of 24,000 units. On the same page in its bottom half, we'll now build a purchases budget. Prepare a direct materials purchases budget for Miles Manufacturing for January and February using the preceding information as well as this additional information. Each unit requires 2 pounds of materials. Materials cost is 60 cents per pound. Miles estimates that it will have 4,000 pounds of materials inventory on January 1st. And Miles' desired ending inventory for materials is 5,000 pounds. To build a materials purchases budget, we need to grab the output of the production budget as the starting point. I realize your workbook only asks for January and February, but I'm going to include March just to emphasize the process. From those units to be produced, we need to determine the quantity of materials needed for production, which we can do by multiplying it by 2 pounds per unit. If you need help visualizing the math for any of these budgets, just use dimensional analysis. We have units produced. To get pounds of material required, we would multiply that number by 2 pounds per unit. Now that we know how many pounds of materials are needed for production, we need to figure out what is our total pounds of material required. It's not the same number as materials required for production because we also need to cover the desired ending inventory of 5,000 pounds. Finally, we can now calculate materials to be purchased by subtracting beginning inventory. January will have a beginning inventory of 4,000 pounds, meaning Miles Manufacturing will need to purchase 46,000 pounds of material. For February, January's ending inventory will be February's beginning inventory. Likewise, February's ending inventory becomes March's beginning inventory, so materials to be purchased for February and March will be 45,500 and 48,000 pounds respectively. The materials to be purchased for each month is expressed in pounds of materials, but to finalize the budget, we need to convert those figures into their cost or dollar values. We can do that by multiplying pounds of material by 60 cents per pound. The cost of materials to be purchased will be $26,600 in January, $27,300 in February, and $28,800 in March. Turn over one page to your right. Prepare a direct labor budget for Miles Manufacturing for January and February using the preceding information as well as this additional information. It takes 2 hours of direct labor to produce 1 unit, and the direct labor rate per hour is $15. Our starting point for the labor budget is units produced. Which we can pull from the production budget. If we can determine the total hours required for production, we can then convert those hours to a dollar amount. We know it takes 2 hours of direct labor to produce each unit, so we can multiply total units by that rate to get total production hours. From these hours, we can calculate the monthly cost of labor. Just use the labor rate of $15 per hour. In the bottom half of the page, let's prepare a factory overhead budget for Miles Manufacturing for January and February using the preceding information as well as this additional information. The variable overhead per direct labor hour is $18. The total fixed overhead per month is $8,000. If you're ever stuck on how to get started, consider what information you have, then how can you use that information to get what you need? Our variable overhead rate is $18 based upon direct labor hours. So if we multiply that rate by each month's total direct labor hours, the resulting product will be in total variable overhead. We ascertain total production hours on the direct labor budget. So multiply those hours by the variable overhead rate, and the total variable overhead will be $810,000 for January, $819,000 for February, and $864,000 for March. Total fixed overhead is provided as a single monthly amount of $8,000. Add that number to total variable overhead for the month, and the sum is total overall overhead. Turn over another page to your right. Bird Bath & Beyond has the following data for use in developing the budgeted income statement for January. In letter A, we have estimated sales for January. In letter B, we have estimated inventories at January 1st. In letter C, we have desired inventories at January 31st. Letter D gives us direct materials used in production. Letter E provides anticipated cost of purchases and beginning and ending inventory of direct materials. Letter F has direct labor requirements. Letter G gives us estimated factory overhead costs for January. Letter H provides estimated operating expenses budget for January. Letter I gives us estimated other income and expense for January. And letter J specifies an estimated tax rate of 25%. Using the previous information, let's build the following budgets. Hopefully you have a copy of the course workbook. If not, maybe rewind this video and copy the previous tables for reference so you can try a few budgets on your own before watching the solutions. Starting with the sales budget. The table in letter A has the projected January sales for birdhouses and bird feeders. For both of these products, multiply the budgeted sales volume by each unit's respective price to get total sales in dollars. We expect to sell 7,500 birdhouses at a sales price of $66 per unit and 5,000 bird feeders at $82 per unit. Multiply those numbers together, and we have budgeted birdhouse sales of $495,000 and budgeted feeder sales of $410,000, giving total budgeted sales of $905,000. Number 2, prepare a production budget for January. The production budget is built by referring to the following tables. Estimated inventories at January 1st, and estimated inventories at January 31st. You'll find a space for building the production budget at the top of page 6. The starting point for the production budget is the budgeted sales volume, which you can find either in our sales budget or in the corresponding table. Add desired ending inventory for January 31st and deduct the estimated beginning inventory as of January 1st, and the result is total units to be produced. Our ending inventory can be found in the second table above, 400 birdhouses and 250 feeders. Beginning inventory is estimated at 500 birdhouses and 210 feeders. Total units to be produced, 7,400 birdhouses and 5,040 bird feeders. Number 3, prepare a direct materials purchases budget for January. To build a materials purchases budget, we'll start with units to be produced. You'll find a space to build the materials purchases budget at the bottom of page 6. For this budget, we'll need materials used to make each product along with the cost per unit. Starting with the wood row, we need 5,920 board feet of wood for total birdhouse production, the 7,400 units to be produced times 0.8 feet per unit. We also need 6,048 board feet for bird feeders, 5,040 units times 1.2 feet per unit. For plastic, we'll need 3,700 pounds for birdhouses and 3,780 pounds for bird feeders. To these two figures, we'll add the desired ending inventory for January to get total units for production. Subtract from that sum the estimated beginning inventory for January to get the total units that must be purchased. Referring back to our tables for beginning and ending inventories, the ending January inventories are estimated at 200 feet of wood and 340 pounds of plastic. January's beginning inventories are 198 feet of wood and 420 pounds of plastic. Now that we have our total feet and pounds of direct materials to be purchased, we need to convert both these units into dollar amounts. We can do so by multiplying them by their respective unit prices. $9 per board feet of lumber, and $1.40 per pound of plastic. Total cost of material purchases, $118,270. Number 4. Prepare a direct labor cost budget for January. In item F, we retrieve our direct labor requirements of our product lines. We also need our total units to be produced. You'll find some space at the top of page 5 to build this budget. We first need to determine the total labor hours in each department for each product. The birdhouses will require 1,850 direct labor hours, the number of units times 0.25 hours per unit. They will then require 2,220 direct labor hours in assembly, 7,400 units times 0.3 direct labor hours per unit. Bird feeders require 2,016 direct labor hours in fabrication, and 1,764 labor hours in assembly. The total hours required in each department, 3,866 hours in fabrication and 3,984 hours in assembly. We now convert these total labor hours into monetary amounts by multiplying them by their respective hourly rates. $20 an hour for fabrication and $15 an hour for assembly. The total direct labor costs will be $77,320 for fabrication and $59,760 for assembly. The total direct labor cost, $137,080. Number 5. Prepare a factory overhead cost budget for January. Item G provides the necessary information for overhead costs. You'll find some space at the bottom of page 7 for building the overhead budget. This particular budget is as straightforward as possible. List each of the overhead items and their costs, then sum the total. Number 6. Prepare a cost of goods sold budget for January. Work in process at the beginning of January is estimated to be $33,600, and work in process at the end of January is estimated to be $41,200. This budget follows the same format as the cost of goods sold manufactured statement I covered in the first chapter. We'll build that statement using the budgeted numbers, then sandwich it within the calculation for cost of goods sold, again using the budgeted numbers. The formula for cost of goods manufactured is beginning work in process inventory plus the period's total manufacturing costs minus ending work in process inventory. Since our information is for January, beginning work in process inventory is as of January 1st, and ending work in process inventory is as of January 31st. Beginning work in process inventory plus total manufacturing costs is total overall manufacturing costs incurred to date. With this formula, we can start building this budget. This budget is going to be rather sizable, so allow me to slide a little bit of the header off the page to make some room. Our January 1st and 31st work in process inventories are provided in the problem information. We need only determine the period's manufacturing cost to calculate the total manufacturing cost and subsequently the cost of goods manufactured. Manufacturing costs are the sum of 3 specific costs: direct materials, direct labor, and factory overhead. We already determined the latter 2 costs in our previous budgets. Direct labor can be found on the direct labor cost budget. $137,080. Likewise, budgeted factory overhead can be found on its respective budget that we previously prepared. $138,900. As for direct materials, you might be inclined to think we can pull that number from the direct materials purchases budget, but this line is not for materials purchased, but instead materials put into production. That amount is a result of beginning direct materials plus direct materials purchases less ending direct materials inventory. For direct materials inventory as of January 1st, that information is found among our schedules. the schedule in letter B to be specific. You'll find the schedule for desired inventories as of January 31st in letter C, and the dollar value associated with direct materials in letter E. Starting with beginning direct materials inventory for wood, we have 198 board feet present. Multiply that quantity by $9 per board feet, and we have 1,782 of wood in beginning inventory. Do the same thing for the 420 pounds of plastic, but multiply it by $1.40 per pound. The result is $588 worth of plastic. The total dollar value of direct materials inventory on January 1st, $2,370. The materials purchases comes from that particular budget. $118,270. Total materials available for use is therefore $120,640. We'll repeat the same method for determining the dollar value for ending materials inventory, but use the schedule from item C. These computations indicate that we anticipate having $1,980 of wood, and $476 of plastic. For a total ending direct materials inventory of $2,456. The total dollar value of direct materials put into production will be $118,184. Total period manufacturing cost is, as a result, $394,164, giving a total manufacturing cost of $427,764. The total cost of goods manufactured, $386,546. Now, to get cost of goods sold, we will sandwich these calculations within the calculation for CGS. The formula for CGS is beginning finished goods inventory plus cost of goods manufactured equals cost of goods available for sale less ending finished goods inventory equals cost of goods sold. We can determine finished goods inventory as of January 1st from our schedule. The information from Schedule B, to be exact. We'll have $14,000 of birdhouses and $8,400 of bird feeders for a total beginning finished goods inventory of $22,400. Combine that $22,400 with cost of goods manufactured, and cost of goods available for sale is $408,964. Finished goods inventory as of January 31st can be found on the schedule in item C. Calculate these two products, then sum them to get total ending finished goods inventory of $21,200. Total budgeted cost of goods sold, $387,764. Number 7. Prepare a selling and administrative expenses budget for January. This budget is extremely straightforward. All the necessary information is in the schedule in item H. Before we can proceed, we need to identify each item in the schedule as either a selling or an administrative expense. How about sales salary expense? That's a selling expense. What about advertising expense? That's also a selling expense. Office salaries expense? That's an administrative expense. Depreciation expense on office equipment? Administrative. Telephone expense, selling. Obviously, that's selling. Telephone expense admin, administrative. Travel expense selling, selling. Office supplies expense, administrative. Miscellaneous administrative expense. That's an administrative cost. Now we can put these items on the budget, grouped accordingly. Our sales costs will be listed together. As were our administrative costs. Total selling expenses will be $107,500 and total administrative expenses will be $21,300. Overall, total budgeted selling and administrative expenses will be $128,800. Number 8, prepare a budgeted income statement for January. A budgeted income statement takes the identical format as a regular income statement, just using the budget's numbers in place of actual ones. We'll use the multi-income state format. Sales revenue less cost of goods sold equals gross profit. From gross profit, subtract operating expenses grouped by selling and administrative expenses. This deduction yields the company's operating income. To that number, we add or subtract the net of other revenues and expenses. For Bird Bath & Beyond, we'll have interest revenue and interest expense. Then we arrive at net income. Starting with sales revenue, that information was calculated in the sales budget. $905,000. We also already figured the cost of goods sold from its respective budget. $387,764. Gross profit will be $517,236. We also have the budgeted selling and administrative expenses already prepared. $107,500 of selling expenses and $21,300 of administrative expenses. Total operating expenses sum to $128,800, making operating income $388,436. Interest revenues and expenses are in the schedule from item I. $450 of interest revenue and $294 of interest expense. Thus, we have a net other revenue of $156, giving us a net income of $388,592. Unfortunately, we're not done. You may have noticed in the previous slide an income tax rate of 25%, meaning we must deduct our income taxes. Consequently, this amount is not actually net income, but rather income before taxes. Subtract from this number the income tax expense, and we're finally at net income. $25% of $388,592 is $97,148, and net income will therefore be $291,444. Turn to page 10 so we can tackle a cash budget, starting with cash receipts. The sales budget of Carson Industries projects the following sales for January through May. In January, $235,000. In February, $250,000. In March, $270,000. In April, $212,000. And in May, $220,000. Carson sells 30% of its merchandise to cash customers and 70% to credit customers. The sales on credit are collected in full the month after the sale. Determine the amount of cash that Carson will collect from cash sales and accounts receivable during the months of March, April, and May. We'll begin this budget with the relevant month sales. We need to isolate the portion of each sales figure that is actually cash received. So deduct 70%, the portion of total sales that were on credit. Cash sales for March, April, and May are $81,000, $63,600, and $66,000. The previous month's credit sales are collected in cash in the subsequent month. So March's $189,000 credit sales are received in April, and April's $148,400 of credit sales are received in May. The credit sales received in March are from February. $175,000. Cash collections from sales are $256,000, $252,600, and $214,400. Flip over one page to page 11. Using your cash receipts budget and the following additional information, prepare a cash budget for the months of March, April, and May. Cash disbursements for March, April, and May are $260,000, $251,000, and $210,000 respectively. The cash balance as of February 28th is equal to $6,000. The minimum amount of cash the company likes to have on hand is $5,000. If the company does not have that amount at the end of the month, it can acquire a short-term loan with a 1% monthly interest rate. Round to the nearest dollar. We determined our cash inflows already. Next, we'll incorporate our monthly outflows. Subtract those disbursements to arrive at the net cash inflow or outflow for each month. March has a $4,000 net outflow, while April and May have net inflows of $1,600 and $4,400. Add the net cash flow to the month's beginning cash balance to arrive at a preliminary cash balance. The beginning cash balance for March is $6,000. Thus, March's preliminary ending cash balance is $2,000. Carson Industries has a required minimum cash balance of $5,000, which it can meet with a short-term loan if necessary. We'll add a $3,000 cash loan to the preliminary balance of $2,000 to arrive at the month's ending cash balance of $5,000. That loan, however, has an interest payment associated with it, and that payment is going to adjust the cash disbursements for April and May. The loan's monthly rate is 1%. So we'll add 1% of $3,000 to April's disbursements. Or $30. The net cash inflow for April drops to $1,570. April's beginning cash balance comes from March's ending cash balance. Combine that amount with the net cash inflow to get a preliminary cash balance of $6,570. Carson Industries has excess cash over $5,000 that it can use to repay that loan, so it'll repay $1,570, just enough to leave it with that minimum $5,000 cash balance, which will become May's beginning cash balance. The interest payment for May will be the remaining loan balance times 1%. $14.30. The problem specified that we round to the nearest dollar, so May's disbursements becomes $210,014. The net cash inflow is now $4,386. Combined with the beginning cash balance of $5,000, the preliminary cash balance is $9,386. Carson has enough excess cash to repay the entire remaining loan balance of $1,430. May's ending cash balance will be $7,956. That concludes this video. There may be a couple of problems in the workbook I didn't cover. If so, you can find their solutions in the course module on Blackboard. I encourage you to try them on your own to test your retention of the material. Please let me know if you have any questions. Thank you for watching.